I want to talk about a concept today that I actually studied in undergrad when I was going for my psychology and business degree. And also, this topic came up a lot during my MBA as well. And after grad school, I made a ton of mistakes falling right into this fallacy. And the fallacy I'm talking about is sunk cost fallacy, or in the investing world, sometimes called the sunk cost trap. Now, what is that? Well, it occurs when you stubbornly and intentionally follow through on an endeavor, even though it's not meeting your expectations. So, an example would be you buy a ticket to a movie, the movie sucks, it's terrible, you don't want to watch it, but you already paid for it, so you just eat a bunch of greasy popcorn and waste an extra hour watching the rest of the movie, even though you're bored to death, because you already paid for it. So then, since you already wasted half an hour and some money, you say, well, I might as well just waste another hour. It doesn't really rationally make sense, but it's this fallacy that happens. And it's not just with financial decisions. Like a lot of people in relationships, they're stuck in a really toxic situation, but they feel like they already sunk a lot of time, they sunk a lot of money, and they sunk a lot of effort. And, it's intimacy and fun during the nighttime. They put in the work, they're miserable, but they're with someone, and they say, you know what? Let me just stay in here because my past behavior, I put so much into this, I might as well stay. And that's an irrational way of thinking, but it happens a lot because you're basing your decision on past behavior, and it's not always healthy. So why does this happen? Because a lot of people, they're afraid of cutting their losses short. Again, I'm not just talking about investments, I'm talking about personal life, I'm talking about careers. They just feel like if they quit, they're a failure, they're a loser, they'll be proven wrong. Like if you're in an investment and it's down 90%, you're only wrong if you actually sell and realize that loss. And so a lot of people, they will just continue to be in a sinking ship because of the sunk cost fallacy. And in investing, I find it happens a lot with options traders because options, they disintegrate so quickly, and rather admit that you were wrong or admit defeat in the very beginning, especially if it's going the wrong way, they hang around because that date may be a couple of months out and they say, well, yeah, I'm down that much, but maybe things will turn around. I don't want to really sell and realize that loss. And what happens most of the time is that they lose the money they put in. And so they remain committed at all costs. And this happened a lot during the past couple of years with a lot of these Wallstreetbets plays. Wallstreetbets became so popular. There's certain plays, and I'm not going to call them out because I don't want to upset the communities, but there's certain plays where so much time was spent on the memes, on the community, on watching YouTube channels day in and day out that followed certain plays, certain short squeeze opportunities. Like literally every single day they would live stream, they would put out video content, and there would be so many people following them. They knew everything about these YouTubers. They knew about their personal lives. They knew about all the inside jokes. They were a part of a community, and they put their money where their mouth is, where their conviction was. But what happened is that the thesis got eroded over time. But instead of just say, it's a sunk cost fallacy, let me catch myself here, let me cut my losses short, they did something that I feel is a sister of sunk cost fallacy, and that's confirmation bias. They just put themselves in an echo chamber and just wanted to hear what they wanted to hear. And that's it. They would search for things, and if anyone else is saying something different, they're crazy, or they would make up conspiracies about them, and that's it. They're definitely right. There's no way they're wrong, or they would extend the time horizon. This is another trick that a lot of financial gurus use, and also people that are lying to themselves. Basically, what they say is, well, I'm wrong now, but in 10 years I won't be wrong, in 20 years I won't be wrong. And so they just extend it out 10 years. That way there's no way they're wrong now. But there is something called opportunity cost, and when you have stuff sunk, you still have some that you could save and apply to potentially better investments. So it becomes a question of what is worth sticking out, what is worth rolling the dice on, and what is actually worth thinking about and saying, this is a sunk cost fallacy, maybe I should remove it. And probably the answer is that you always have to have a plan. Me personally, when I go into an investment, I write down why I'm investing. Sometimes I make a video about it and then I go in, but usually I write down exactly why I'm going in, and I write down a price or a price range that I want to exit the position if it goes up a certain amount, or revisit the position if the thesis is still strong and it's climbing for the right reasons, not because of euphoria. Then I keep my money sailing right along. Also, I have a stop loss strategy in place. So I always have stop loss orders or at least jotted down. This is the amount that I am willing to be wrong by. You have to do these things because it's so easy to get caught up and start listening to financial YouTubers, or it's not even financial YouTubers, anywhere where you found information, you made an investment. It's always hurtful to be wrong. And so it's so easy to just get caught up in this sunk cost fallacy. But the way to really avoid that is to be objective and not to just say, well, because I was in this play for so long and I put so much money in and it's going down, but I've been in it for so long, so I'm going to continue to do it. Think of it this way. If today you had the choice to go in this play, would you go into the play? And if the answer is no, maybe you have to talk about it objectively with someone. I mean, obviously, I'm not a financial advisor. Maybe seek the advice of somebody that is smarter than you, wiser than you in the space, or someone with the same intellect that maybe you just want to bounce ideas off of and see if you are actually objectively looking at the situation and still for the right reasons are in it. Because these past couple of years, a lot of people made a tremendous amount of money. And now that there's a downturn in the market, I mean, the comment section that I see on Reddit, on Facebook, it's becoming so nasty because people are just turning on one another. People are calling out financial gurus and people are just saying that everything's a scam. And then other people, they actually do something that I consider to be even more unhealthy, which is confirmation bias. They just put themselves in an echo chamber where it's a lot of people that think the same way, they say the same things. And if anything goes against their thesis, regardless how rational or logical it is, they just say, no, this is all shills. This is all people that work for hedge funds. This is all corrupt people. Only we are right, and we're definitely right. And the only people that can be in this group are the people that are right. And the reason I know this is because I'm a little bit of a skeptic, if you haven't noticed, about investments, about certain cryptos. By the way, I've talked about stocks. This goes for cryptos as well. The best thing you could do is just educate yourself and learn from your mistakes. But the reason I say this about these groups is because I'm a pretty skeptical investor. Even in things that I'm bullish on, I always try to look at all different arguments. I try to look at it objectively. I try to take emotion out of it. I mean, personally, I think it's incredibly hard to be objective about anything. We are people, we are subjective. And as much as we try to be objective and fair and logical, we're always filtering things through an emotional filter because we're humans and that's what happens. Unless you are a sociopath and are heavily medicated, you're going to have emotions and there will be decisions and thesis that you're forming that is based on emotions and not fully on reason. We're not robots. But when I put out certain videos and I post them to certain groups, I've gotten blocked from so many groups because sometimes I make YouTube videos and then afterwards, when it's relevant groups, if I made it about a certain stock or I made it about a certain theory or I made it about, certain types of options trading or cryptos, stocks, I post it in relevant groups on Facebook and Reddit and I get blocked from a lot, not because it's irrelevant or because you're not allowed to share YouTube stuff, but because people just get angry and they're like, oh no, this guy's against the player. He's saying something that's FUD. FUD is like a huge thing people say. I think that FUD should be a part of your due diligence. FUD should literally be a part of fundamental analysis. Like you should put FUD everywhere in your notes. And then as you read it, you should see if it scares you out of the position or if you can handle it. Because a lot of times people invest and then when FUD happens, they ignore. But what happens is they're ignoring sometimes actually salient points and red flags, yellow flags, and they're just saying, no, it's all FUD. And what happens is they FUD trap themselves into a garbage position. So I'm just curious. I feel like I've been rambling a bit and, I didn't cover a specific stock like I usually do, but I just wanted to cover this topic. I'm curious if you've ever heard of sunk cost fallacy or sunk cost trap. Now that I mentioned what it is, do you feel like you ever fell victim to one? Are you in one right now? Let's talk about it in the comment section. And just to let you know, just to give myself as an example, I got stuck in sunk cost fallacy with two stocks that are in my bag holder portfolio right now. One of them is Jumia And the other one, even though it's a long-term play, I would say is Nano Dimension. And one of the reasons is because I make videos about them. The videos do well. And a part of that reasoning, I said, well, I already put so much effort in and I have a bit of a following and all that stuff. And I just went and I let these things slide to like really, really low numbers. And I'm holding the bag on these two investments. And so I don't mind sharing that. I'm wrong a lot. I'm not pretending to be a stock guru. I'm not selling you any courses. I don't have any Webull behind me. I'm not selling you any Red Bull, Webull, any of that stuff. I'm just someone that's interested in the stock market, interested in the psychology and behavior of money, and also am a crypto enthusiast as well. And so I follow these things. I make videos sometimes, make some ad revenue sometimes, but I'm not selling you any courses. And please, if you watch this channel, please make no mistake. I am not a financial guru. I have had good years where I made a bunch of money off investments, but that doesn't mean that's going to happen again this year, next year, or the next 10 years. Nobody knows what's going to happen. Don't let anybody tell you different. There's no guru out there, no Warren Buffett, no hedge fund, not your mom, not your dad, not your priest, and definitely not the people that cover finance on YouTube. So with that being said, let's talk about it in the comments section, and I'll see you guys in the next video.